May 28, 1962, New York City. The Dow Jones Industrial Average drops 34.95 points in a single day. That does not sound like much until you understand that the entire index is only sitting at 576 points. That is a 6% freefall in one afternoon. The worst single day on Wall Street since the crash of 1929. Billions of dollars in wealth evaporate before the closing bell. Grown men stand on the floor of the New York Stock Exchange and cannot speak. The ticker tape runs so far behind actual trading that investors are making decisions based on prices that are already 45 minutes old. They are flying blind into a wall. But here is what makes this moment genuinely strange. There is no war starting. There is no bank failure. There is no plague, no crop failure, no earthquake. The American economy in the spring of 1962 is, by virtually every conventional measure, doing well. Unemployment is falling. Corporate profits are rising. The post-war boom is still running. And yet the market is in freefall. And the man most people blame for it is not a banker or a speculator or a foreign government. He is the President of the United States. A young, popular, charismatic president who 6 months earlier had approval ratings above 70%. How does a sitting president at the height of his popularity cause the worst stock market crash in a generation? And why does the dynamic that broke the market in 1962, the collision between political power and financial markets, keep reappearing in every era, dressed up in different language but following the same logic every single time? This is the story of the Kennedy slide. By the end you will understand how the relationship between Washington and Wall Street can become a fuse, see the 7-step pattern that turned political confidence into financial panic, and recognize the warning signs that appear every time a government decides it knows better than the market what prices should be. This is not just history. This is a warning that has been issued in every decade since and will be issued again. But to understand how this happened, you have to go back, way back. It is the spring of 1961, Washington, D.C., and the city is electric with a feeling that is difficult to describe to anyone who did not live through it. John F. Kennedy has been president for exactly 100 days. He is 43 years old, the youngest man ever elected to the office, and the city feels younger because of him. The old Eisenhower administration, with its generals and its gray suits and its careful, conservative management of the post-war order, is gone. In its place is something that feels, to the people working in it and the journalists covering it, like a genuine new beginning. The best and brightest, as they are being called in the newspapers, have arrived from the best universities and the best law firms and the best think tanks, and they are going to apply the most sophisticated tools of modern economics and modern management to the task of running the largest economy in the world. The American economy in 1961 is a particular kind of magnificent. The industrial base built during the Second World War is still running at high output, producing steel and automobiles and consumer goods for a population that is growing, earning and spending with an energy that no previous generation of Americans had experienced. The middle class is expanding at a rate that economists will spend the next 50 years trying to explain and replicate. A factory worker in Detroit or Pittsburgh or Cleveland can buy a house, send his kids to college, take a 2-week vacation and retire with a pension. This is not a fantasy. It is the lived experience of tens of millions of American families in the post-war decades, and it is built on a foundation of industrial production that is, at this moment in history, essentially uncontested anywhere in the world. Germany and Japan are rebuilding. Britain is recovering. The Soviet Union is producing weapons, not consumer goods. America is the workshop of the world, and the workshop is booming. The stock market reflects this confidence with almost painful littleness. The Dow Jones Industrial Average, which had sat below 200 points through most of the 1950s, crosses 700 points by late 1961. Mutual funds, a relatively new vehicle for ordinary Americans to participate in equity markets, are attracting billions in new capital from middle-class investors who have never owned stocks before. The cover of Time magazine runs a story about the new investor class. The ordinary Americans who are building wealth through the market with the same methodical discipline they apply to everything else in their lives. The bull market of the late 1950s and early 1960s is not a speculative frenzy. It is not tulip mania or the South Sea bubble. It is, by the standards of the time, a rational reflection of genuine corporate earnings growth in the most productive economy in human history. But beneath this prosperity, there is a structural tension that the Kennedy administration inherits and initially does not fully appreciate. American steel is the backbone of industrial production, and American steel is expensive. The major steel companies, organized in an industry structure that borders on oligopoly, set their prices in a way that is more cooperative than competitive. The United Steelworkers Union, one of the most powerful labor organizations in the country, negotiates contracts with the companies that consistently deliver wage increases that outpace productivity growth. The result is a steady upward pressure on steel prices that flows through to every manufactured product that uses steel, which is essentially everything. The Kennedy administration, stuffed with economists who have been reading John Kenneth Galbraith and Paul Samuelson, understands this dynamic clearly. What it does not fully understand is how its attempt to fix it will light a fire that nobody planned to start. Meet Roger Blau. He is the chief executive of United States Steel, the largest steel producer in the country, and, in 1962, one of the most powerful corporate executives in America. He is not a villain in the conventional sense. He is a careful, formal, conservative businessman who believes, with genuine conviction, that his job is to maximize returns for his shareholders, and that the government's job is to create conditions in which he can do that job. He does not particularly like John Kennedy. He does not particularly like what he sees as Kennedy's coziness with the labor unions, and he is about to make a decision that will start a war. But Eleanor Dulles, an economist at the State Department who has spent decades watching the relationship between government policy and financial markets from close quarters, sees something that most of her colleagues are missing. She notices that the Kennedy administration is talking about business and labor and prices in a way that sounds to the people in the corporate boardrooms and on the trading floors less like governance and more like control. The language coming out of the White House, the talk of the public interest and national purpose, and the social responsibility of corporations is making the financial community nervous in a way that is hard to quantify but very easy to feel in the market data. She raises this in a memo that is read, filed, and not acted upon. And then there is Walter Heller, the chairman of Kennedy's Council of Economic Advisors, a brilliant academic economist from the University of Minnesota who genuinely believes that the tools of modern macroeconomics can be used to fine-tune the American economy the way an engineer fine-tunes a machine. He is not entirely wrong about this, but he is operating with a confidence in the precision of those tools that the tools themselves do not warrant. He is about to advise the president to pick a fight he does not know how to finish. What none of them know yet is that a handshake deal made in good faith is about to become the most consequential broken promise in the history of American financial markets. January 1962, the Kennedy administration has spent months working out a careful agreement with both the steel companies and the Steel Workers Union. The logic is elegant in theory. The union will accept a modest wage increase, well below what it has been demanding. The companies, in return, will hold the line on steel prices. Inflation stays contained. The administration can point to responsible management of the economy. Everyone wins. Roger Blau shakes hands. The union accepts the terms. The deal is done, or so the White House believes. The logic of the administration's position rests on something the economists call the wage price guideposts, a framework that Walter Heller and his colleagues have developed to keep wages and prices growing in line with productivity without formal controls. It is, as economic frameworks go, intellectually elegant. It is also entirely voluntary, meaning it has no legal force, no enforcement mechanism, and no consequence for non-compliance beyond whatever political pressure the White House chooses to apply. In the boardrooms of the major steel companies, the executives look at this framework and see it for what it is from their perspective. Suggestions from politicians who do not understand how their business works, carrying the implicit threat of executive branch displeasure but nothing more. The question is whether the White House actually has the stomach to use whatever tools it has. The answer, delivered on April 10, 1962, will surprise almost everyone. April 10, 1962, United States Steel announces a price increase of $6 per ton across its product lines. The announcement comes on a Tuesday afternoon. By Wednesday morning, every major steel company in the country has matched the increase. Within 48 hours, a price rise that the administration has staked its economic credibility on preventing has been implemented by the entire industry simultaneously in what looks from the outside like a coordinated move designed to present the government with a fait accompli. Roger Blau delivers the news to Kennedy in person, in the Oval Office, the evening before the announcement, handing him a 4-page press release as if he is filing a routine business notification. Kennedy reads it. He says very little. Then Blau leaves, and the President of the United States picks up the phone and spends the next 72 hours in a fury that will reshape the relationship between his administration and American business for the rest of his presidency. Kennedy's response is something that, in 1962, has almost no precedent in the modern American presidency. He goes to war, Not a polite disagreement or a formal objection lodged through the appropriate regulatory channels. An all-out public, personally vicious campaign to force the steel companies to reverse their decision. He holds a press conference and delivers a statement so charged with personal anger that reporters who cover him regularly are visibly startled. He calls the steel executives in a line that gets repeated in every newspaper in the country men of bliss who are wholly indifferent to the public interest while asking Americans to serve their country, to pay higher taxes and make every sort of sacrifice. The Justice Department opens an antitrust investigation. The FBI sends agents to interview steel executives and reporters. Defense contracts are redirected towards smaller steel companies that have not raised prices. The pressure is relentless, coordinated, and nakedly political in a way that makes the financial community watch with growing alarm. Within 72 hours, the steel companies back down. United States Steel reverses its price increase. The others follow. Kennedy has won. He appears on television that Friday and the administration treats it as a triumph, a demonstration that the president will not allow narrow corporate interests to override the national interest in price stability. The press largely agrees. His poll numbers hold. In the immediate term, the confrontation looks like a clean victory for the White House. But on Wall Street, something has shifted. The victory that Kennedy is celebrating is being read by the people who run money and capital in the American economy as something considerably darker. It is being read as a signal that this administration is willing to use the full power of the executive branch to override private business decisions it disagrees with. The antitrust investigation, the FBI visits to executives, the redirection of federal contracts as punishment for a legal price decision. These are not the actions of a government maintaining a stable environment for investment. These are the actions of a government that has decided it will intervene in market outcomes whenever it chooses to, and the market begins to price that risk in. April turns to May and the selling is quiet at first. A few large institutional investors reducing their exposure to industrials. Some defensive rotation into utilities and bonds. Nothing dramatic, but the direction is unmistakable to anyone watching the data carefully. By the middle of May, the Dow has dropped almost 100 points from its December 1961 high of 734. That is a 13% decline from the peak, and it is accelerating. The administration is watching and issuing reassuring statements, but the reassuring statements are themselves contributing to the problem, because every time a Kennedy official says the fundamentals are sound, the financial community hears an administration that does not understand why the market is selling off in the first place. Then May 28th arrives. It is a Monday. The selling that had been methodical and gradual for 6 weeks suddenly becomes a rout. The Dow drops 34.95 points, the worst single-day loss since October 29, 1929. Volume on the New York Stock Exchange is so heavy that the ticker tape cannot keep up. By the afternoon session, investors are trading against prices that are 45 minutes old, in a market that is moving violently in real time. The specialists on the exchange floor, whose job it is to maintain orderly markets by buying when there are no other buyers, are overwhelmed. Some simply step back from their posts. The market structure itself is fraying. By the closing bell, 9.35 million shares have changed hands, a volume record that the exchange is entirely unprepared to process. The Board of Governors of the exchange meets in emergency session that evening. The financial press is already calling it the Kennedy crash. The name sticks. This is the top of the bottom, and nobody knows how much further it will fall. Then one morning, something quiet happens. It is a Tuesday, May 29, 1962, and a man named Keith Funston, the president of the New York Stock Exchange, drives to Washington to meet with Treasury Secretary Douglas Dillon before the markets open. The conversation is not about emergency intervention or market suspension. It is about something simpler and more urgent. Dillon calls Kennedy's chief of staff. Kennedy calls his press secretary. And before the opening bell that Tuesday, word begins filtering through the financial community from multiple directions that the President of the United States wants it known, not in a formal statement but in the unmistakable way that these things are communicated, that he believes the stock market is undervalued, that he believes the economy is fundamentally sound, and that this administration is not at war with American business. The message is deliberate, its delivery is informal, and it works, at least partially, at least for now. The market opens on May 29th and the selling continues for the first hour. Then it stops, then it reverses. The Dow gains back 27 points by the close, one of the largest single-day point recoveries in its history to that point. The panic is not over, but the free fall has been arrested. Over the following weeks, Kennedy and his advisors will work to repair the relationship with the business community through a series of signals, statements, and policy adjustments that amount to a tacit acknowledgement that the steel confrontation had been, whatever its merits in policy terms, catastrophically misread by the markets. By June, the selling has mostly stopped. By year-end, the market will have recovered most of its losses, but the episode leaves a scar that does not fully heal during the Kennedy presidency. The people who held throughout the slide eventually recover. Hirsch Greenbaum, a 58-year-old accountant in Brooklyn who has been buying stocks through a mutual fund since 1957, watches his retirement account lose 22% of its value in 6 weeks and feels a fear he has not felt about money since his father lost everything in 1929. He does not sell. He is too paralyzed to sell, and then the market starts coming back, and by December he is almost whole again. He does not understand why it happened, and he does not trust that it will not happen again. He holds less equity for the rest of his investing life because of those 6 weeks in the spring of 1962. Patricia Hendricks, a widow in Columbus, Ohio, took the advice of her broker in January 1962 and moved the proceeds of her husband's life insurance into a diversified stock portfolio. She loses $18,000 of a $60,000 portfolio before the recovery begins. Her broker tells her to hold. She holds. By September she is down only $8,000. She considers it a learning experience and will describe it that way for the next 30 years without ever fully reconciling the feeling of watching her husband's life insurance vanish in real time because a president had a fight with a steel company. But James Dunbar, a portfolio manager at a Boston investment firm who had been reading the political signals from the Kennedy administration since the inauguration, and had quietly reduced his equity exposure in February and March of 1962, watches the slide from the relative safety of a heavily cash-weighted portfolio. He is not celebrating. He is troubled by how easily the relationship between a government and its financial markets can be destabilized by a confrontation that was never about the markets at all. He writes a note to his clients that July explaining what he observed, and the note is prescient enough, about the relationship between political uncertainty and market behavior that it gets passed around investment firms in Boston and New York for years afterward. And still, nobody at the highest levels of the Kennedy administration said out loud the thing that needed to be said. We scared the market, and we did not understand until too late that frightened markets do not respond to reassurance. They respond to credibility, and still, nobody asked the real question. So what really happened? History books describe the Kennedy slide as a story about market overvaluation correcting itself, with the steel confrontation as a convenient trigger that accelerated an inevitable process. That explanation is not just wrong, it is dangerously wrong, because it treats the episode as a market story when it is actually a political story. And the distinction matters enormously for understanding what the real risks were and what lessons carry forward. Here is what actually happened. The Kennedy administration came to power with a theory of government economic management that was intellectually sophisticated and practically dangerous. The theory was that modern economists, equipped with the right data and the right models, could actively manage the American economy to optimize output, minimize unemployment, and control inflation simultaneously. The tools for doing this included fiscal policy, tax rates and government spending, monetary policy, and something new and more aggressive, the use of executive pressure to directly influence private pricing decisions. The wage price guideposts were the formal expression of this third tool, and the steel confrontation was the moment when the administration decided to enforce them by any means available. What the economists in the administration did not fully weight in their calculations was the effect of this approach on what economists call the investment climate, the aggregate confidence of the people and institutions whose decisions to invest higher and expand determine whether the economy grows or contracts. Investment decisions are not made on the basis of current conditions alone. They are made on the basis of expectations about future conditions. And the future that the Kennedy administration's steel confrontation implied, a future in which the executive branch would use antitrust investigations, FBI agents, and procurement leverage to override legal private business decisions, was a future in which the return on this investment carried a political risk premium that had not previously existed. The mechanism is worth understanding clearly, because it operates in every era regardless of the specific political context. When a government demonstrates a willingness to intervene in market outcomes unpredictably and aggressively, investors must price in the possibility that any investment they make today could be subjected to intervention they cannot anticipate tomorrow. This is not irrational fear. It is rational risk management applied to a new and poorly defined risk. The required return on investment increases to compensate for this uncertainty. Higher required returns mean lower asset prices for any given level of earnings, because the present value of those future earnings is being discounted more heavily. Equity valuations fall, not because the underlying businesses are performing worse, but because the environment in which they operate has become less predictable. The steel company's earnings did not collapse in May 1962. What collapsed was the multiple that investors were willing to pay for those earnings, because the rules under which those earnings would be allowed to flow to shareholders had suddenly become unclear. The people who made money during the Kennedy slide were not the ones who predicted the steel confrontation specifically. They were the ones who had been reading the general signal correctly since the inauguration. The signal that said this administration views large corporations as instruments of public policy rather than private property, and adjusting their risk exposure accordingly. James Dunbar in Boston was not prescient in the specific sense. He was attentive in the general sense. He noticed that the language of the Kennedy administration toward business was fundamentally different from the language of the Eisenhower administration, and he made a probabilistic bet that this difference would eventually produce a market-moving incident of some kind. He did not know it would be steel. He knew it would be something. Here is the pattern, and it is worth memorizing because you will encounter it in some form in every administration that follows. First comes the new paradigm, the belief that this time the government has both the tools and the wisdom to actively manage economic outcomes in a way that previous administrations could not. Second comes the easy money environment, where low interest rates and strong corporate earnings create a bull market that reinforces the administration has confidence in its own capabilities. Third comes the social proof cascade, where rising markets are interpreted as validation of the administration's policies, which encourages more ambitious interventions. Fourth comes the complexity that obscures the actual risk being built into the system. In this case, the political risk premium being silently priced into investment decisions by people who are watching the administration's behavior carefully, but not saying so publicly. Fifth comes peak euphoria, the Kennedy administration's certainty in March 1962 that its steel agreement represents a masterclass in economic statesmanship and that the era of wage price stability has arrived. Sixth comes the trigger, which is Roger Blau walking into the Oval Office with a press release and the president responding in a way that removes any ambiguity about how this administration will treat private business decisions it disagrees with. And seventh comes the blame game, the weeks of White House briefings insisting that the market decline is about overvaluation and profit-taking, and has nothing to do with the administration's behavior, even as the private communications between the Treasury and the exchange make clear that the White House knows exactly what caused the slide and is working to address it. Once you see this pattern, you cannot unsee it. Now let us talk about 2024 and 2025, because right now the relationship between government and markets is more active, more interventionist, and more explicitly political than at any point since the Kennedy era, and the market is pricing this in ways that most financial commentary is not adequately explaining. The Biden administration used the Defense Production Act, the same legislative framework Kennedy used to redirect steel contracts, to intervene in semiconductor production, battery manufacturing, and pharmaceutical pricing. The Trump administration returned to the White House in 2025 with an explicit agenda of using tariffs and trade policy as active tools to reshape domestic production and employment, producing market volatility in the first months of 2025 that echoes the pattern of spring 1962, in ways that are instructive to examine carefully. Let us run through the checklist. The new paradigm is present in both major parties simultaneously, which is unusual. The left version says that industrial policy, the direct government direction of investment into strategic sectors, represents a more sophisticated form of capitalism than the hands-off model of previous decades. The right version says that tariffs and managed trade represent a more honest accounting of the true costs of globalization than the free trade consensus of the post-Cold War era. Both versions agree that active government management of economic outcomes is not only legitimate but necessary. This is precisely the confidence that animated the Kennedy administration in 1961 and produced the confrontation of 1962. Easy money has transitioned into tighter money since 2022, but the debt structures built during the near-zero rate era remain and are now being Corporate America is carrying more debt than at any previous point in its history. Government is carrying more debt than at any point outside of World War II. The system's sensitivity to interest rate changes, and political uncertainty is therefore higher than the simple headline numbers suggest. Social proof is operating at full intensity in the equity markets, where a decade and a half of generally rising prices has produced a generation of retail investors who have never experienced a genuine bear market and who interpret every significant decline as a buying opportunity. The technology sector in particular carries valuations that require assumptions about future earnings, growth that are, by historical standards, extraordinarily optimistic and that have very little tolerance for the kind of political risk premium that a shift in the regulatory or trade environment can introduce. Complexity is, if anything, greater than in 1962, with derivative instruments and algorithmic trading strategies creating feedback loops in market structure that the Kennedy-era specialists on the exchange floor could not have imagined. Peak euphoria existed in the AI investment theme through 2023 and 2024, with valuations in the semiconductor and large language model space reflecting assumptions about the pace and breadth of AI adoption that depend entirely on a stable, predictable regulatory and trade environment for the chips and data infrastructure that make the whole system work. Now, is this exactly like 1962? No, and saying so would be misleading in important ways. Kennedy's confrontation with Steele was a discrete, identifiable event with a clear political actor and a clear corporate response. The current environment is more diffuse, with political risk coming from multiple directions simultaneously, from trade policy, regulatory action, geopolitical competition, and fiscal uncertainty. The financial system is also vastly more interconnected and more responsive than in 1962. Which means both that shocks propagate faster and that corrections can be sharper and more self-reinforcing. These differences cut both ways. They make catastrophic events less likely to have a single, identifiable cause and more likely to be the cumulative result of multiple small confidence shifts. They also make it harder for a single presidential signal, the equivalent of Dillon calling Kennedy's chief of staff on the morning of May 29th, to arrest a decline once it has started. What should you watch for? Watch how administrations talk about private business decisions they disagree with. Because the language governments use about corporations carries information about the degree to which they see themselves as having the right to override those decisions. Kennedy's language in April 1962 shifted in a single press conference from the vocabulary of encouragement to the vocabulary of accountability and punishment. And the market heard that shift immediately, even if the political press did not fully process it for weeks. Watch the response of business investment data to political events, because the capital spending decisions of large corporations are the leading indicator of how the investment community is actually reading political risk as opposed to how it is characterizing that risk in public statements. And watch what happens to long-term interest rates when political uncertainty increases. Because bond markets have historically been faster and more honest than equity markets in pricing the risk that government behavior introduces into the economic system. The pattern is there. The question is whether you will recognize it in time. So why do we keep falling for this? Not because governments are malicious, though some are, and not because markets are irrational, though they sometimes are. We keep falling for this because the relationship between political authority and economic freedom is genuinely contested in every generation, and the contest is never definitively resolved in either direction. Kennedy believed, with genuine conviction, that the steel companies had broken a good faith agreement and that the national interest in price stability justified a forceful response. He was not wrong about the agreement or wrong about the interest. What he misjudged was the second-order effect of his response on the confidence of every investor and every corporate decision-maker who was watching how the President of the United States treats legal private business decisions he disagrees with. He won the battle and started a war he did not mean to start. This is not a failure of intelligence or a failure of intention. It is a failure of imagination about the system of which he was a part, and the way that system would interpret actions that looked, from inside the administration, like necessary enforcement, and looked, from outside it, like a new and dangerous precedent. Every generation of politicians faces this same temptation and this same blind spot. The temptation is to believe that the levers of executive power can be used to produce better economic outcomes than the market would produce on its own. The blind spot is the second-order effect on confidence, on investment planning horizons, on the premium that investors require to compensate for political risk that they cannot model or predict. The market does not punish good intentions. It prices uncertainty, and nothing creates uncertainty more reliably than the demonstration that the rules of the game can be changed by a phone call from the White House. There is a lesson here that goes beyond economics and beyond the specific politics of 1962. It is a lesson about the limits of the belief that sufficiently intelligent people with sufficiently good intentions can manage complex systems without creating unintended consequences that partially or fully offset the benefits they were trying to produce. The Kennedy administration was not short of intelligence or good intelligence. It was short of humility about the scope of what it could predict and control. That humility is not a counsel of passivity. Governments must act. Economies require governance. The steel confrontation was not wrong in its objective. It was costly in its execution because the people conducting it did not adequately model the audience for whom the performance was being staged. The investors, the corporate planners, the pension fund managers, the small savers in Brooklyn and Columbus, all of them were watching, and what they saw was not a display of capable stewardship. It was a display of political force that made the future feel less predictable than it had the day before. That is the real lesson from the spring of 1962, and it is a lesson that applies with equal force to every administration, of every political orientation, in every era that follows. You cannot control what the next administration will decide to do with the tools of executive power. You cannot control which industries it will choose to favor or challenge, which prices it will try to hold down or push up, which business decisions it will treat as private matters, and which it will treat as public concerns, subject to government override. What you can control is your own framework for reading political risk in a market context, your ability to notice when the language of governance shifts from enabling to controlling, and your willingness to act on what you observe rather than what you are told to feel. Kennedy recovered his relationship with Wall Street by the end of 1962. The market recovered its losses by early 1963. Hirsch Greenbaum's retirement account recovered by December, but the 6 weeks of spring 1962 remain a precise and documented case study in how quickly the relationship between a government and its financial markets can deteriorate when that government underestimates the sensitivity of private investment decisions to signals about political intent. History gave us that case study for free. The tuition for ignoring it is considerably higher. Now I want to hear from you. Which current political action do you think is most likely to produce a Kennedy slide equivalent in the next 12 months? And which administration in your memory handled the government markets relationship best? Drop your answer in the comments. The most useful perspective in these discussions always comes from people watching it unfold from inside their own economies and portfolios. If this changed the way you see the relationship between political decisions and market prices, hit the like button. Subscribe if you want more stories like this one. Next time we are looking at the Hunt brothers silver crisis of 1980. The moment two Texas billionaires tried to corner the global silver market and instead created a financial emergency that required a weekend intervention by the Federal Reserve. Another pattern hiding in plain sight. Another lesson they do not teach in school. Remember, history does not repeat, but it rhymes. And right now, the rhyme is running at full volume. See you in the next one.